I'm now going to change from discussing transparency in the Sukuk market to discussing it in the Islamic collective investment scheme market. And again, I will cover a little background because it may well be that there are people joining us whose expertise is outside collective investment schemes. Most people, I think, have come across collective investment schemes one way or another. Some places they would be referred to as mutual funds. And they are normally structured under particular legal forms. So people will come across open-ended investment companies, unit trusts, sometimes limited partnerships. Exactly what will be used will depend on the legal system. Different systems have different legal forms available. One of the bits of good news about Islamic collective investment schemes is that they adopt the same set of structures normally as their conventional counterparts. So you do not have to think about new and complex structures based on different contractual forms. But the biggest difference for an Islamic collective investment scheme is that it can only invest in Sharia compliant assets. And we'll talk a little bit more about what that means and what it means for disclosure later. But there are operational and practical differences as well. It can only behave in a Sharia compliant way. And in general, that means no short selling. Again, there are some scholars in some places, particularly Malaysia, that believe that equivalents of short selling are possible in some situations, but they are very much a minority. Also, most kinds of derivative are not regarded as Sharia compliant. So again, that limits the forms of transactions that can take place. It means that in practice, it is difficult to the point of impossibility to structure an Islamic hedge fund. There have been examples in the past, particularly in the United States, of people who thought they could structure such a thing. They didn't get very much traction in the market, and the scholars remain extremely skeptical about whether it can be done. So what you're normally looking at is basically a long-only fund investing in relatively simple things. I'll concentrate at the beginning on those funds that invest in securities of one kind or another, but I'll talk a little bit later about some special cases. The other thing you would expect about an Islamic collective investment scheme is that so far as possible, its operational aspects are also Sharia compliant. An obvious example there is the bank accounts that it uses to hold money going to and from its participants. Clearly, you would want those to be in an Islamic bank, or at very least to be non-interest paying. I said that an Islamic collective investment scheme can only invest in Sharia compliant assets. That means it needs to have some kind of Sharia screening methodology to enable it to determine what are compliant assets and what aren't. Let me deal with the sort of straightforward case first, which is a scheme investing, shall we say, in equities or in bonds. Being Islamic, there'll be sukuk. And some of this thinking can be extended to other areas. First thing is to say that the operator of the collective investment scheme may, of course, have its own Sharia screening methodology. I said, this is the way we are going to look at any new investment. It can, however, just rely on the investment being included in some form of Islamic index or another. So it could say, we will invest only in equities that are included in the S&P Global 1200 Sharia index. That's a real index. It's maintained by S&P. And an operator could say, we will essentially take no decisions of our own. We'll just follow that index. Another option for the operator is to buy in a screening methodology from someone else. For example, it could go to S&P and say, we would like, for a fee, to use your screening methodology, but we want to apply it to a wider universe of equities than you've looked at, because after all, you haven't looked at many Central Asian equities. We want to operate in that area. So tell us how to screen them, and we'll apply it to a lot of things you've never looked at. So that's buying in a screening methodology. Whatever screening methodology you use, it will normally have both qualitative and quantitative elements. So the first thing you will do is to look at the business that has issued this security and say, is that business something that is basically Sharia compliant? That will exclude quite a lot of things. Clearly, it will exclude brewers and pork farmers, and it will pornographers. Most scholars would say it will exclude businesses in the arms trade. And we could give one or two others. Clearly, it will exclude conventional banks because they earn their living from interest. Generally, scholars will accept that this is an imperfect world. They may be willing to accept a limited amount of non-Sharia compliant income. Perhaps the fact that a big chain of supermarkets sells a small amount of alcohol can be tolerated, subject to something I will talk about in a moment. So that's what the qualitative screen will look at. There will also be a quantitative element, because you would not want the scheme to be investing in a business that is either paying or receiving substantial amounts of interest. So the screen will typically look at its financials and it will say, oh dear, no, this business has a large amount of conventional debt. It is obviously having to pay quite a lot of interest. And actually, even though that amount, they may say, even though that amount is not very high this year when interest rates are low, well, they wouldn't have to move very much for this to be a real burden. So it could be excluded on the conventional debt it holds. It could also be excluded the other way round. Perhaps it's sitting on a huge cash pile and it's going to be earning significant interest from the banks. So there will be a quantitative screen that looks at factors like that and says, can we invest in this or not? Associated with Sharia screening is what you do about non-compliant investments. There are two ways this may turn up. One, as I've suggested, is that you may have a business which earns a small amount of its income in a non-compliant way. It's generally accepted that an Islamic fund could hold that investment, but it must purify the non-compliant income by giving that proportion of whatever dividend or profit it receives, by giving that proportion to charity in a way, again, that Sharia scholars have approved. You can also, of course, have an investment that was compliant and becomes non-compliant along the way. Perhaps you have invested in a chain of poultry farms, nice compliant poultry farms, and they decide to merge with a chain that farms pigs. Clearly, what had been a compliant investment becomes non-compliant. The collective investment scheme will be expected to divest from it, but that will take time. There may be non-compliant income coming in the meantime. So again, there has to be a way of doing this. All of this screening methodology, including things like the treatment of non-compliant income, should always be approved by a set of competent scholars. Again, that set of competent scholars may be maintained or consulted by the operator, or it may have been maintained by someone like S&P, who put an index methodology together. One difference between collective investment schemes and the sukuk I talked about earlier is that Sharia governance is a continuing issue. You would expect the operator always to be buying and selling investments and worrying about whether they have changed their status. So the compliance mechanisms within the operator, even if no fundamental changes need to be made in the methodology, will always be an issue. How does it make sure it actually keeps obeying the rules as time goes on? Having talked about that difference, and I will talk about its disclosure implications later, I flag some regulatory issues in ICIS markets. Often, ICIS markets, like their conventional counterparts, are retail markets. If you're working in a retail market, then disclosure will probably not be the only regulatory tool you're applying. You may be using concepts like suitability, requiring advice to be given to investors before they participate. Almost certainly, your disclosures will need to be simpler, even if you say that there is going to be a huge prospectus and it must be given to every investor. You may well be requiring some simplified form. What you will almost certainly have is a lot of product and operational requirements. For example, regular valuation of the assets, holding of assets in custody, management of conflicts of interest between the operator and the investors. Those will be perfectly normal things. They'll be in all the IOSCO core principles and other standards that are familiar to ICIS, well, to any CIS regulator. I'm conscious in this context that you are, in one sense, not a normal jurisdiction. You are an international financial center operating within a limited geography, just as the Dubai International Financial Center, where I worked for some time, operates. You may find that your collective investment schemes are less retail than is common in the market, and that you have a niche which is for, I believe you call them exempt schemes. That is, schemes aimed at professional investors, perhaps in a relatively small number. Clearly, your balance of the regulatory considerations in that situation will be a little different. You may well assume that you have investors who can understand more detail, and if their numbers are small enough, may be able to negotiate some of the issues for themselves rather than just taking what's put in front of them. In that case, you may be putting, if anything, a little more weight on disclosure, but not requiring it to be quite so simple. You would certainly put less weight on things like suitability in that situation. I can touch on the implications of that in a moment. One thing that is common in collective investment schemes is that operations cross borders. And you may well have a collective investment scheme which is domiciled in jurisdiction A, invests perhaps globally, perhaps in this S&P Global 1200 Sharia index, and is marketed in a whole collection of other places with different regulatory regimes. It may have various contractors or intermediaries involved. Perhaps it contracts out some of the investment management in, shall we say, in China to a manager based in Hong Kong. Perhaps it contracts out custody. It very likely does. Perhaps its products are sold through intermediaries. That's very common in collective investment schemes. So they're marketed through financial advisors and banks. Amani talked early on about the way that capital markets are commonly intermediated, and you need to think about the role of the intermediary. So the role of any particular regulator may actually be limited to some parts of the chain. That's particularly likely to be the case for you because a fund which is domiciled in the AIFC is probably going to be doing a lot of its investments outside, and that will raise some issues for you. In this session, however, I am supposed to be concentrating on disclosure, and once again, the IFSB standard in question is IFSB 19. Again, I shall draw on it, but I shall not give you the absolutely complete guide to every specialist point that is made in it. Now, the same high-level principles, I suggest, apply to disclosure for collective investment schemes as apply for Sukuk. Disclosures need to be clear and accurate, but note that what clear means in a retail market is very different from what it means in an institutional market. Getting the points that a retail investor needs to know over in a comprehensible way is always a major issue. The disclosures need to be sufficient. Again, the same concept applies. And of course, they need to be timely. Even the retail investor wants to know whether he or she should be buying into an investment in a collective investment scheme or selling out of it. Timeliness may, if anything, be more important in this situation, where the investor may not be following every development in the market day by day. What are the specific disclosure issues for an Islamic collective investment scheme that would not apply to a conventional one? Well, the important one, of course, is the Sharia screening methodology. I talked through how those things work, particularly in the context of equity investment. If you were thinking about a money market fund, the details of screening would be different, but the principle that you need a Sharia screening methodology and that it has to be specified would remain the same. Whatever the methodology is, and it will be tailored to the investments that the scheme makes, some disclosure of it needs to be made, and disclosure needs to be made of which scholars have approved it. Again, similar things are true as were true in Sukuk. You would expect to see the names of the scholars with brief biographies. You might want to see some of their reasoning. For a collective investment scheme, I suggest there would also be disclosures, probably at a prospectus rather than a key information document level, about Sharia governance. How are decisions being made along the way? What is the compliance mechanism to make sure that the people actually doing the business are following the approved methodology? you would expect that to include probably some internal and external Sharia audit arrangements. Whether it does or not, I suggest you would still want a disclosure about it. I've discussed the issue of tainted income, the small amount that is not compliant just because that's the nature of the business, and tainted assets, assets that move from compliance to non-compliance, and again need to be dealt with normally by selling them off, but which generates some income in the meantime. So there should be disclosures about how they will be dealt with. As in the case of Sukuk, there will be the question of whether the operator or the fund pays zakat on behalf of participants. The answer is probably no, but at least participants should know that the responsibility devolves on them to pay their own zakat. I suggest there should also be operational disclosures about matters like whether all the monies passing to and fro are being held in accounts with Islamic banks. In some cases, there may be physical assets which need to be insured. Is that being done in an Islamic way? I flagged all these as points for disclosure. What you would want to think about from a regulatory point of view, though, is how far do regulators become involved in the substance of these things? I've suggested that in institutional markets, regulators can very well say, we are not going to be involved in the substance. We don't care what your Sharia screening methodology is, provided it's been approved by some scholars and provided you disclose it. Regulators might say, we don't care who your scholars are, provided you disclose their names. Institutional investors probably can take their own advice on whether they regard those people as competent. Perhaps in a retail market, you might decide to be more demanding on that. Again, in a retail market, you might decide that you want to make some provisions substantively about Sharia governance, like there should be proper internal Sharia audit. I'm not trying to force you to one set of answers or another. Competent regulators have taken different views on these things. But in looking at a regulatory regime, it is something you will want to think about. How far will I rely on disclosure alone, and how much on substance? Having talked about what you might want disclosed for a relatively straightforward fund, a fund investing, say, in equities or in Sukuk, I should flag the fact that there are specialist funds of one kind or another. There will be money market funds, and I believe that Amani has already illustrated that they make up a significant part of the Islamic collective investment scheme universe, at least by assets under management. Clearly, they cannot invest in interest-paying instruments, but they can invest in short-term Sukuk. They can invest in placements, probably under profit-sharing investment accounts with Islamic banks, and so on. They will raise slightly different issues. I will flag one of them in a moment. You will find real estate funds, including REITs, real estate investment trusts. There will be exchange-traded funds, which of course may be investing in any of the kinds of underlying we've talked about. There will be funds that invest in commodities, private equity funds, and so on. And some of those funds pose disclosure issues that go beyond those of their conventional counterparts. For example, the allowable types of investment. a conventional commodities fund would probably be investing in commodity futures and options. In general, the Sharia scholars are not going to be very happy about those. So there would need to be some disclosures about what kind of instruments that commodity fund, shall we say, believes it can invest in. Similar issues may apply around money market funds. There will also be some operational issues. Again, taking money market funds as an example, some funds in the conventional sphere have had various methods of value stabilization. The standard language has been that there has been a promise not to break the buck, i.e., never to let the value of an investment fall below the principal. Doing that in a Sharia compliant way is difficult to the point of impossibility. So if a money market fund believes it is actually doing that and it holds itself out as an Islamic fund, it would certainly need to make disclosures about what it's doing. And I would say it would need extremely good Sharia advice. To give an example of the way that special issues can arise, I'm going to talk in detail about just one example, and that's a real estate fund, because it throws up a lot of issues, and working your way through them, I think, will give you an idea of how those issues might arise in other circumstances. The first thing you're thinking about is the Sharia compliance of the investments you make. Now, in this case, what you will be screening for first is the Sharia compliance of the underlying property use. Okay, in some cases, that may be straightforward. Investing in domestic housing is not a problem. Investing in student accommodation is not normally a problem, and I've seen funds that try and do that. Once you invest in commercial property, you start raising questions. Yeah. I'm conscious that you in the AIFC have a large shopping mall immediately opposite. Could an Islamic collective investment scheme hold that? Well, you would then say, what tenants do you have there? Some conventional banks. They're not Sharia compliant, are they? Perhaps you've got some restaurants that are serving alcohol. Some problems of Sharia compliance there. So with a property fund, depending on the amount of non-Sharia compliant income, the scholars may say you can't touch it at all, or they may say you can hold it, but you must purify your income by giving some of it to charity. Even if the latter of those is true, the impact on your financials may be significant. You've certainly got to have a way of dealing with that tainted income and disclose it. It may be in practice that the fund operator will say it is easier to avoid it. It is easier to stay with a straightforward business like domestic property. By the way, similar issues of compliance would occur if you were looking at investing in office buildings, say. Again, they may have tenants whose business is not Sharia compliant. Okay, the next thing, you've got some properties. Fine, I imagine you will want them insured. Are they going to be insured in a Sharia compliant way? And what disclosures are you going to make about that? It may well be that there is a problem securing takaful or some other form of Islamically acceptable insurance. It's possible that if there genuinely is not an operator who could do it, that your Sharia scholars would allow, under the principle of necessity, that you place the insurance with a conventional company. But at least you would want both to have taken that advice and to disclose what you're doing. Next question. Real estate funds very commonly take out mortgages over their properties. It gives them some leverage, and that generally makes their returns look an awful lot better. If there are mortgages in an Islamic real estate fund, are those mortgages Islamic? Are they with an Islamic bank which is structuring them in one of the ways acceptable in Sharia? Small, tricky issue around that. Suppose you get through that. Suppose that you have got an Islamic bank that has given you an Islamic mortgage. Who holds the title to the properties? And that is tricky because some of the best known Islamic mortgage structures, things like diminishing musharaka, involve the bank holding title or holding partial title to the properties, unlike conventional mortgages in which it would be the fund that held the title, albeit that the properties are pledged as security. You may think that doesn't matter. Why am I making heavy weather of this? I'm making heavy weather because I'm a regulator, and I know that one of the things regulators normally expect is that a fund will hold title to its assets. It's straightforward if they're shares. It's the fund that owns the shares, not anybody else. But if I've got this real estate fund, then perhaps the fund cannot actually hold title while still having a mortgage on the properties. There are ways through that. There are structures you can devise that will give investors the same protection that you would get from the fund itself holding title, but which will fit with a Sharia compliant mortgage. However, getting to those solutions is likely to need the regulator to change its rules a bit and to admit some structures that it would not normally admit for a conventional fund. Next question, and the answer could go either way. Suppose your real estate fund doesn't actually hold the entire property. It shares ownership with 2 or 3 conventional investors. Are those investors allowed to raise conventional finance against their share of the property to pledge it as collateral for a conventional loan? The answer may be yes or no, and the scholars will decide whether it's permissible or not. But again, there is an issue for disclosure there. Last one on this list. Property funds, real estate funds, are famously illiquid because if people start redeeming their units in the fund, it always takes time to sell real estate. So property funds always have the possibility of running into a liquidity crunch. There are various means of dealing with that, of raising the money to make repayments to those who want to withdraw their cash. Note that some of them will not be Sharia compliant. Yeah. Borrowing from a conventional bank clearly will not be. So if a real estate fund has mechanisms in place to deal with any liquidity crunches, then they need to be compliant. And of course, again, proper disclosure will need to be made about what those are. So that was simply an example of how a specialist fund can raise specialist issues. And I could have spent my time working through a different kind of fund, perhaps a money market fund. But you can read in the standard the kinds of issues that arise for specialist funds. And I hope that at least illustrating the kind of issues that may arise will give you the tools for thought when you get to those. And I just want to end on three of what seem to me to be the bigger regulatory questions. The biggest one, to which I've alluded before, is how much can disclosure achieve? And the more the market is retail, I suggest, the less you can rely on disclosure alone. You can put 200 pages of detailed documentation in front of the man or woman in the street, but even if it's a highly intelligent person, you cannot necessarily expect that they will understand the risks that are involved. You will have the question of how much you rely on disclosure and how much on other things. To take a straightforward example, I suggest that most of the people listening to this, who will be financial services professionals, could not necessarily read the names and short biographies of 4 Sharia scholars and say, these are people I trust to interpret Sharia in a way that I am happy with, or these are people I really do not trust very much. I don't much like their qualifications, and they have some views on certain contracts that I disagree with. Big institutional investor can do that. Can a retail one? Is disclosure of the names of a set of Sharia scholars sufficient in that area? I said different people can come up with different answers, but it's worth thinking about. Another one for collective investment schemes is, what is the role of intermediaries? It's something that Amani alluded to, because commonly collective investment funds are sold through intermediaries. Banks, other financial institutions advise on them. Yeah, I can look at the websites of Islamic banks in a number of other jurisdictions, and I can see that they are offering collective investment schemes, including Islamic ones, from providers in other places within one structure or another. What is the role of intermediaries? What do you expect them to do in relation to funds that are domiciled elsewhere? Do you expect them, for example, to take their own Sharia view on compliance, or simply pass on the claims that have been made by other people? Another tricky issue. And it's associated with the fact that those issues may well be arising cross-border. Suppose you have an Islamic bank in your center, and it wants to market a range of collective investment schemes. Very likely those will be offered by someone based somewhere else, with their own Sharia advice. Alternatively, maybe the bank itself wants to run its collective investment schemes, but it wants to run them on a global basis. So it wants to contract out the investment that is going into, shall we say, the Gulf states, to someone based a bit closer to them. What approach will be taken to that? Those don't have easy answers. Different people approach them different ways, but I suggest that they are issues that you would want to think about. Once again, that's as much as I want to say in this session. Does anybody have any questions?
Yes, Mr. Casey. Here is the 2 questions addressed to you. The first one is, how do Islamic grade managers ensure that their properties are not subleasing to non-Sharia compliant entities? And the second one, how do you estimate the current state of AIFC Islamic finance status, its success and plans? what are the necessary features that need to be implemented?
Okay. The first one is reasonably straightforward. Islamic collective investment schemes, Islamic REITs, usually invest in a relatively small number of properties. And they, after all, will be owning them or will be owning a very large percentage of them. It is not hard in those circumstances, even if they have letting agents for them, both to either to put constraints on those letting agents, you may only let for Sharia compliant uses, or themselves, if they are in charge of it, to know what is going on. The whole point of the Islamic REIT, I think, is that you have a degree of control. They will certainly want to keep a degree of control over the property. The second way of doing it, of course, is to invest only in properties that are unlikely to have non-Sharia compliant uses. If you invest in residential property, and probably whatever planning arrangements you have, it will be zoned for residential use only, then the uses are going to be residential, and nobody has a problem with Sharia compliance in those cases. Nobody expects a REIT to look behind the fact that you are a tenant and say, oh dear, where does this person get his income from? So the use, residential, will be acceptable. Similar things are true of student accommodation. So I don't think Islamic REITs have a big problem in either knowing that their tenants can only be Sharia compliant, unless, of course, their letting agent has broken all the rules and let this house do bit for something it's not zoned for, or they themselves have control, directly or indirectly, on who the tenants are. So that's the relatively straightforward issue on Islamic REITs. As to the AIFC's Islamic rules and Islamic infrastructure, I know that you have taken some very good advice on the structure of regulation for Islamic finance. There is always a question when you are trying to build an Islamic finance structure as to how much you build and how fast. Do you try and put in a complete Islamic finance infrastructure before you've got anybody operating in the jurisdiction? There are some areas, I suggest, that you cannot put in before you have people operating in the jurisdiction. If I leap out of capital markets and go to Islamic banking, I would say, well, normally you would think about
recording in progress.
Whether to put more substantive requirements on. But look, I would need to do a proper review of your regime to try and give advice in any more detail than that. If you've got areas of specific question, though, do ask them.
I think there's no questions for now. Then I need to say thank you very much, Mr. Peter Casey, for your session and for your answers to that questions. Your Excellencies, distinguished guests, ladies and gentlemen, we will now take another break for 10 minutes and we will come back soon. Thank you very much.
Thank you.